Good afternoon. I'd like to use this video to explain a bit more about discount rates. There's also an accompanying PowerPoint you should look over, as we'll be referring to that during the video. First off, in week 3, I had asked a question about what would you consider when choosing a discount rate. Many of you correctly identified the factors such as the length of time, the cost of capital of the company, the riskiness of the investment. During week 4, I said, okay, we had that discussion last week. I'd like you to select a discount rate for this furniture company that was one of the examples in the Brooks text. And I've gotten lots and lots of questions about what would go into that and how you would do it. So we posted a little bit more information, and I'm still getting questions. So what I'd like to do is follow up with this video a bit. Okay, so first off, the correct answer to what goes into the selection of a discount rate, which is also known as a hurdle rate, which can also be known as a required return, would be the length of the investment as well as the riskiness of the investment, the cost of capital of the business. As an example of kind of riskiness and cost of capital, consider two different investments. For those of you who took your lottery winnings from a couple weeks ago, all of you took the lump sum, we're going to live off the interest on it. You now have an opportunity to invest $1 million from those lottery winnings. And you have two choices for the investment. One, you can invest the $1 million in a blue chip company in the United States, such as IBM. Or you can give it to your brother-in-law, who has this idea that he's going to create a search engine that will compete with Google and, in fact, over time will become better than Google. Well, if we look at those two investments, IBM's a stable company. It has an existing source of revenue. It's probably a pretty solid investment. It's nothing too dynamic. It's very large. It's probably not going anyplace. Your brother-in-law, on the other hand, trying to invent Google, could, in fact, invent the next Google and have a fantastic return. Or he could end up like many other internet companies and go out of business. So if you were looking at investing in those two companies, you would probably say to your brother-in-law, well, your investment's a lot riskier, so I would like a larger return investing in you than I would investing in IBM. That's kind of the conceptual framework for it. If you'll turn to the second slide, the slide 2, it's the first actual slide in the presentation, you'll see we've presented a yield curve. Okay, and this happens to be a Treasury yield curve. I took it off the Google page that I had posted in the discussion forum, or the, I'm sorry, not the Google page, the Yahoo Finance page that I had posted in the discussion forum. If you look at the yield curve, what it shows you is that for a longer, rates are higher the longer you invest. On this particular yield curve, if you look at it, rates are almost 0 for a 2-month investment. Rates are about 2% for a 5-year investment. If you go all the way out to 30 years with an investment, it's about a 4-year investment. It's about a 4-year return. So this means the longer you invest money, this is the U.S. Treasury yield curve, so this is the longer you invest your money with the United States government, the higher yield they have to pay you. Okay, so that shows you kind of the time difference. The longer you invest, the higher the yield. Okay, now if you move to the next slide, it's called Treasury rates on risk-free investments. You'll see some numbers. I've put an arrow highlighting the 5-year Treasury. Just have to highlight some number for discussion. Let's look at a 5-year investment. And this basically says for a 5-year Treasury rate investment, the current yield as of yesterday is 2.02%, let's say roughly 2%. This means that if you give money to the United States government, you loan your money, you buy a Treasury bill, you invest your money with the United States government, you're going to get a 2% return over the next 5 years. The United States government is in the marketplace the most risk-free investment. And again, if you consider, let's say, the United States government versus some other business, the example I was thinking of, for those of you who live in the Northeast, you probably know Bernie's Appliances, the store. It was in Enfield. There was a couple branches in Springfield and Hadley and Holyoke and some places. Bernie's went out of business a couple months ago. Turns out Bernie's went out of business a few years before that, too. About 10 years ago, they were merged with Newmark and Lewis, and had gone out of business. So Bernie's has gone out of business once about 10 years ago. Bernie's went out of business sometime earlier in 2010. In the paper the other day, the son of the founder, Bernie's son, was trying to buy the name Bernie's back from the bankruptcy court, and he was going to open another business called Bernie's and sell appliances again. So if you're considering investing with Bernie again, you'd say, well, Bernie, you've been out of business 3 times. You've been bankrupt twice. I think I might require a little bit larger return than if I invested, let's say, with the United States government. Okay, in other words, if you want money from me for 5 years, Bernie, I'm going to charge you more than 2% because you're riskier. You've been out of business twice, or there's a chance for you to go out of business. So if you look at the next slide, which is labeled Slide 4, it's labeled Corporate Borrowing Rates. This is also from that Yahoo Finance page, and it shows you a variety of different yields that are available on. Again, I've highlighted the 5-year investments. So. And those of you who've been following some of the information, a AAA investment is the highest rated investment, AA, single A, and is actually B level investments as well. So it's 2.97% as of yesterday. Let's say 3% for a. I read my own numbers. It's 2.97% for a 3-year AAA investment. Say 3%. It's also 3% for a 5-year. AA investment. So basically a high-quality investment, high-quality company, the best quality companies, the IBM quality companies, if they had to borrow money in the marketplace tomorrow, they would be charged 3% interest. Okay? Now if we go down the scale a little bit and we look at the single A rate, it's 3.47. Let's say for round numbers it's 3.5. If you looked at a company that was lesser credit than a AA company or a AAA company, they might be charged 3.5% interest in the market. I also looked up in Thursday's Wall Street Journal, the physical copy. I couldn't find it online. The yield rate for high yield bonds. Now, high yield bonds is a fancy name. It used to be called junk bonds. Another name for them might be risky bonds. If we call them high yield bonds, people will buy them. If we call them junk bonds, if we call them risky bonds, they're more difficult to sell. The yield for a risky company, a very risky company, it's probably not a rated company, it's not a B, it's not a C company, it's a D level company, a C or D level company. That was 7.5%. So you can see that IBM might be borrowing at 3%, a company that's less than IBM might be borrowing at 3.5%, a very risky company might be borrowing at 7.5%. So you get that kind of spectrum of yields. Okay, so in terms of discount rates, in terms of cost of capital, if that company had to borrow money, that's the type of yield that they would be looking at in today's market. So for instance, 3.5, 3.47 might be an applicable discount rate to use. Likewise, you could argue that it was 7.5%, like my high yield example. Again, that's a perfect discount rate that you might be using. That's what it would cost the company to go into the marketplace and use for borrowing money. Okay, let's look at the last slide, which is called Yields on Stocks, Cost of Capital from Equity. As you recall from the balance sheet chapter, a company gets money either by borrowing it or from an investor. Well, the stock markets are your investors. And I've highlighted a couple different yields on here. I've highlighted the top two, which are Verizon and AT&T. Their yields are approximately 6.5%. from the slide, and I've also highlighted Coca-Cola, where the yield is approximately 3.3%. And below that is GE and some others. So what this is saying is that the marketplace is saying that an investment, if I were investing in Verizon or AT&T, I'd get about a 6.5% required yield. Okay, I would want a 6% return to invest in AT&T and Verizon. The market is saying that those businesses long-term are not necessarily that stable. They're a little bit riskier. If you know anything about the phone company business, it's because everybody's turning off their landlines and primarily going to cell phones. So people like me, we'll turn off 1 or 2 landlines a year and migrate to a cell phone, even from a business perspective. Coca-Cola, on the other hand, is a good example. It's kind of like IBM. They're being charged a 3.3% rate. So when you look at those are comparable discount rates that you might use. One of the posts that was in the example in the discussion forum was the question was about a chair company or a furniture company, and somebody posted a quote about another Bassett Furniture, which is a furniture manufacturer. If you think about furniture manufacturers, every couple of months there's one on TV going out of business, clearance sale. So they're kind of a risky investment. That particular entity had a yield, I believe it was just 7.05%, riskier than Verizon, riskier than AT&T. So you get the sense that those are the types of discount rates that you have. If I use Coca-Cola as an example, its equity yield is 3.3%. So if it had to go raise equity in a market, it would be charged 3.3%. It's probably a AAA or a AA rated company. If it had to go borrow money from a bank, from Wall Street, it would probably be charged 3%. So either of those two discount rates might be appropriate for Coca-Cola. The concept of that is if it costs Coca-Cola 3% to raise that money, or 3.3% to raise that money, the investment would have to earn a higher return than 3%. Doesn't make any sense. If you borrowed the money at 3% and you only earn 2% on it through your investment, you ultimately lose money. So the idea of a discount rate is to pick a number someplace market-based. Okay? And what I'm trying to do is, with these examples, is provide you some market-based information about how you would pick a discount rate. And we provide a variety of sources that can help you pick that information. There's some other sites. A little bit later in the class, they'll be on some of the CNN Money, Fortune 500 sites and things like that, which will have yields on additional businesses that you might want to look at. But the idea is to pick a number that's somehow based on the market. This is the art part of the class. Yet the information is available, and it's available on the internet. It's available in the newspapers for those of you who read the Wall Street Journal or have access to the Wall Street Journal at the library. And I just wanted to conclude that if there are still questions on how you select a discount rate following this, please let me know. One final thing, as I present this, rates are historically low right now. Typically, bank rates are 5%, 6%, 7%. The fact that all these rates are down around 3% is kind of amazing. But they've been there for a couple of years, and they'll probably continue to stay there. So it means you're earning, as you can see from the future value calculations, you don't earn all that much at 3%. If the market were back up at 7% or 8%, you might be picking numbers that look like that. Again, the idea is, with this video and these slides, is to just explain what's going on and hopefully provide you information so that you understand discount rates. If you have any additional questions, please let me know.